me, it was very striking signal from the oil market itself. Start with the oil market itself, where you got contango at the front end of the WTI futures curve and Brent futures curve and some of the other Middle Eastern curves too. When was that? A week ago from today. So last Monday, the Friday before. So just before the July 4th holiday, you had the market saying, there's a lot of uncertainty in the geopolitics part of it, but the curve was basically flat all the way
Yeah.
across, which to me raised the question of whether or not there's going to be demand destruction already filtering into the market thinking. Now, of course, that's not the case today. Oil prices are up, pretty
Yep.
sharply. In fact, they continue to rise. And was looking for the spreads before we started here. So the curve is steepened out a little bit more on the supply side. But the idea of demand destruction has already seen, in my opinion, my reading of the oil market has already filtered its way back. It's filtered its way into the conversation.
Yeah, I think what's likely to happen, and again, I always say likely because I don't know for sure, but my guess is that we will get an inflationary impulse latter half of this year, early next year. But just because of energy prices, and because I think it's possible that we have higher food prices later this year as a result of some of the chemicals and the fertilizers and the different inputs that go into the agricultural planting season that's now passed. But I think that higher energy prices and higher food prices, even if we get a resolution to this, Iran situation in the next couple of months, could show up later this year. And then that can cause demand destruction 9 months from now, a year from now, 18 months from now. And so when people say, this is definitely going to be inflationary, I'm like, well, I think we can have an inflationary impulse, but you got to remember, if an inflationary impulse becomes too quick and comes too sudden and comes too severe, it leads to massive deflation. And there's no better example than that than COVID, right? You had basically all the shipping lines shut down and the world stopped moving. And so you had a supply chain disruption, prices went through the roof, and markets, or the input costs went through the roof, but then because you couldn't get them. But then you also had demand destruction because the world wasn't doing anything, right? And so, yeah, you had inflation, but it ultimately, goes back to some deflationary pressures as well. And I think that's what we're set up for again.
Yeah. So in that situation where you've got a lot of these factors that are, still lurking under the surface, let's talk about the dollar here. What does the dollar do in this type of situation? Because for the last couple of months, the dollar has defied, I think, a lot of people's expectations. Maybe they set them aside because of the unique circumstances and the extraordinary circumstances of the Iran conflict. But before we got to March, everybody, and I mean everybody, said devaluation, trade, debasement,
Yep.
debasement, debasement. Now all of a
Yep.
sudden it's like, okay, what's we're not getting the devaluation or debasement. Is this a temporary reprieve and that somehow, flight to safety, saving the dollar, or are we seeing something more structural emerge, or the Iran conflict forcing something more structural back to the surface?
I think there's two things here. This topic that you just brought up is really foundational to all of my work. And it's the reason I've pounded the table as hard as I have on
Right,
the
you don't have any
strength.
table left to pound. There's a fist-sized hole there where you've been pounding it so much it
Fair
just goes
enough.
right through.
Fair enough. Fair enough. But and the point is this: is if you go back to 8 years ago when I first started talking about that, I said, listen, U.S. equities are going to go higher, gold's going to go higher, bond price, interest rates will probably go higher. But the dollar's going to go higher as well, just because all of the other currencies, are even worse than the dollar. But the point is that fiat currency does lose value over time. That it's designed to lose value. If the governments of the world didn't want a currency that lost value, they would have stuck with gold. They don't want a currency that does it. Fiat helps them, right? And so the debasement trade is real. If you look over 3, 5, 10, 15, 20, 30, you're going to see debasement of the currency. But the point that I've tried to make is that it is going to be punctuated by terrifying drawdowns along the way. And the reason these terrifying drawdowns along the way come along is because the dollar gets stronger versus foreign currencies. When the dollar gets stronger versus foreign currencies, then you get a credit contraction that can eventually, if not stopped quick enough, can become a liquidity issue, right? You don't just get a credit contraction. You get a credit collapse and you get a lack of liquidity. And then this basically a margin call on the dollar, right? And we've seen that several times over the last 5 or 6 years where, you have this period where everything's running up and then whoosh, you get a 20 or 30% drawdown in asset prices. And then it goes up again and boom. And I think what we saw earlier this year is a good example of why that can happen. As you pointed out, all of last year, especially the end of last year, first part of this year, with after what silver did last year and gold did last year, people were saying the debasement, all you have to do is buy hard assets and sit back and, this is easy street because Trump wants the lower dollar. All of that stuff can be true. But just because that's what they want doesn't mean they're going to get it in a nice, smooth, easy fashion. And so I think what's happening right now is we're seeing a tug of war between what the market is demanding right now today and perhaps what Trump wants 6 months from now, a year from now, 2 years from now. Because I do think that ultimately they do want a weaker dollar. I don't think they want a weak dollar, but perhaps they want it weaker. Maybe they'd like the DXY to be in the mid 90s or low 90s or even high 80s. But when you get a supply crunch and you have to pay up to get something, you need dollars to get the. So when oil's trading at 120 and when copper's trading at 6.5, and when natural gas is in Europe is up 20 or 30%, and when food prices start to rise, those trade in dollars. And so now the countries that don't have dollars need more dollars just to buy the necessities, right? And that is why, you saw earlier this year, despite the debasement trade, despite oil or silver and gold having such great layers last year, as soon as we got into some kind of an uncertain time and a potential liquidity squeeze and higher energy prices that trade in dollars, what happened? The countries that needed to buy that stuff had to sell their treasury bonds or had to sell their stocks or had to sell their gold and their silver in order to get dollars to go buy those commodities. And I think that's the perfect example that even though the system may change someday, to operate on the global stage today, you still need dollars. And that is a long way from no longer being the case. Now, will it change someday? It probably will change someday, but it hasn't changed yet. And there's a number of structural factors that make it more likely than not that it will stay that way for quite a while.